Good morning all, welcome to today's session on what I believe to be an interesting topic of chart psychology. It's great to see some familiar names present, good to see you all. For any newer faces, my name's Aaron Hill and I am a market analyst here at FP Markets. My experience is broadly contained within the technical side of the trading domain, with specific emphasis on price action and related concepts. In fact, for more than a decade, my interest in technical analysis has been, I would say, obsessive, with this drive yet to show any sign of stopping yet, thankfully, as I remain incredibly passionate in what I do. Anyway, before we get things going, I trust I'm coming across loud and clear and the welcome slide is visible. I'm just going to check the questions. Guys, excellent, thank you. Now, we've planned a two-part series for this subject, as it's pointless to try and pack in all the information in one session and leave viewers more confused than when they began. Our intention is to provide sufficient material to empower traders to confidently navigate trading charts, understanding the psychological dynamics behind some of the price movement of buyers and sellers. Our intention is to provide, so more experienced traders might have to exercise a little patience today, as I feel diving into more, shall we say, advanced concepts right off the bat will do nothing but confuse newer traders here to learn. So I will be going over a number of what I feel are basic prerequisites first off. Part two will focus more on advanced concepts. We can also have a part three if required. One other thing I must make clear is that in order to take advantage of market psychology, you must have a good handle on technical analysis. What I mean by this is be reasonably well versed with many of the common concepts. But don't worry, as mastering one concept is really the name of the game before moving on. Okay, as usual, bear with me while I quickly read aloud the disclaimer on screen. The information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. FP Markets has made every effort to ensure the accuracy of the information as at the date of publication. Look, guys, the long and short of it, of course, is to highlight that what we talk about, what is said, is educational and not investment advice. As for the session's topics, there is a lot of information I will throw at you today to prep for part two. So first up, what is chart psychology? At this point, I'll basically go over the term. I will also explain what the market is and also define price action. All of these are elements required to fully grasp chart psychology. Basic trading orders explained. So here we'll kick things over to, as I'm sure is obvious, trading orders. While older hands here will know these orders inside and out, newer traders must also realize their functions, which helps understand how we as traders communicate with brokers and also help define where we might use these orders on charts, which is incredibly important. Next up, finally, in this section, locating orders on charts, we'll talk about how to position ourselves to begin to learn where orders are located on charts and how we can possibly take advantage of this order flow. Do bear in mind that this will not be that detailed, but will serve as a good foundation for part two. Also, the Q&A. If there are any questions, I can take them at this point, but for those of you who know me, will know I usually will take questions throughout the session if related to the concepts being shown. So what is the term chart psychology? This is not anything new, and I'm sure there is plenty of info available from a simple Google search. But nevertheless, I will present my view, and hopefully it is sufficient to help any newer traders here. It may also open another door of research for some older hands present. So chart psychology, or sometimes called market psychology, helps decipher or describe the sentiment of market players on the charts, the emotional biases, if you will. Now, you may come back to this and ask, well, what about automated trading systems? That's a fantastic question and a natural one. A major benefit of automated trading systems are they effectively remove emotions, an element of which a discretionary or even a partial discretionary trader must face. I'm certainly not an expert in non-discretionary automated trading systems and certainly do not have all the answers. In fact, none of us do. But I know automated trading systems are coded by humans in attempt to trade and profit from markets. Therefore, I believe some of the more advanced automated systems work on the premise to take advantage of market psychology, as we will soon be starting to do. If any of us here have experience with automated trading, it would be great to hear your opinion on this, as I can only provide the experience I have gathered over from my years with watching and analyzing price movement. So, what is a financial market? So for newer traders here, I think it's a good idea to first briefly describe what a financial market is. So a financial market is a platform, a platform to facilitate buying and selling. This could be in the stock market, bond market, cryptocurrency market, commodities market, and also the foreign exchange market. An interesting one, of course, is the derivatives market, which is what I'm sure most of us here are involved in, and is simply a financial instrument deriving its value from an underlying asset. Derivatives are the likes of futures, options, swaps, forwards, and CFDs, so contracts for difference. Derivatives are essentially agreements made between two parties, a legal agreement, I might add. So CFDs, as I'm sure you're aware, represent an agreement or contract between two parties to exchange the difference between the opening price of a trade and the closing price. Okay, so look, for a futures trade, both parties in the transaction are anonymous, as futures are exchange traded derivatives, as are most options. Think, for example, the CME, or Chicago Mercantile Exchange, and the Chicago Board of Options Exchange, or CBOE. A forward contract and a futures contract are there to buy or sell something at a predetermined price at a specified time in the future. Just bear in mind, a forward is an over-the-counter market instrument similar to CFDs and swaps. Finally, guys, a futures contract is simply a forward contract that is standardized. It shows specification details, the type, the quality, and the quantity of the underlying asset or commodity. We have a comment here from Travis. I believe he's interested in automated trading. Will FP Markets be doing any future courses on the subject? I'm not sure in the future, but at the tail end of this month, I am doing a webinar on backtesting, which I will touch on systems, how to backtest systems there. If you're interested, Travis, the CMT Level 3 is heavily involved in automated trading, and it really opens your eyes to how much detail is involved in comparison to discretionary systems or partial discretionary systems. So as I said, do make sure to come along to that webinar, and we'll try and dive into as much as we can on that subject. And finally, guys, another thing I would like us to be on the same page with is, of course, is price action. So what is price action? So price action is nothing more than movement of a financial instrument plotted on a chart over time. It is often used to forecast direction of the price of a security. Put simply, price action is how price changes. In other words, it's the action of price. So price action for me is the most important indicator on the charts, of which I tend to use candlesticks to display price data. Of course, you can use bars or line charts along with several other variations to display price movement. I'm certainly not here to say technical indicators do not have a place in your trading arsenal, as they do. I am a fan of the RSI indicator to help with momentum studies. There is debate as to whether oscillators are leading or lagging indicators. I'm not really going to get into that today, but a leading indicator is supposed to help forecast price movement. So it is a signal given before a new move occurs, and a lagging indicator provides a signal after the move has begun. So think of moving averages. For me, oscillators are a bit of both in some respect, as the MACD looks at crossovers, for example, as I said, a lagging concept, but also can be used as divergence, as a divergent signal, which can be considered leading. For the RSI, I find that it is more leading than anything, although it is still a derivative of price action, like the MACD is, hence why price action is a favorite of for me. Right, okay, so we're going to jump into the trading orders here. So for basic order types, I will try to keep this as simple as I possibly can, but it is imperative we all understand these functions to monitor market psychology, as this is how, as I said, this is how traders communicate. So at its core, the two primary order types available in the market are the market order and the pending order. A market order is an order to buy or sell at the next available price level. So a market order is a way of communicating to your broker that you want to be involved in the market now and are essentially willing to accept any price the market gives you. These market orders are particularly useful when wanting to exit a position when the market is moving against you in rapid fashion. Again, though, do take into account that a market order, although guaranteeing execution, cannot guarantee a price. Market orders also tend to be best placed in liquid markets. Now, so liquid markets refer to any market in which there are many buyers and sellers present. Put it simply, usually liquidity is calculated by taking pending trades currently on the market, which with high liquidity often translates to tight or sometimes referred to as low spreads. Market liquidity is important for a number of reasons, but primarily because it impacts how quickly you can open and close positions. So a liquid market is generally associated with less risk, as there is usually always someone to take the other side of a given position. So in terms of liquid markets, we have currency pairs, major currency pairs, so euro dollar, pound dollar, Aussie dollar, dollar yen, are considered liquid instruments, as are large cap stocks, for example. Excuse me, guys. So as an example of how a market order works, take the current slide, the euro dollar trading at 1.40 over 1.4001. The bid price currently rests at 1.40 and the ask sits at 1.4001. If a trader wants to enter long or buy the market right now, 1.4001 is approximately the price you'll receive. This is the ask price. And conversely, a trader looking to short or sell this market is, would be looking at an approximate price of 1.40, the bid value. What market orders can also open up traders to is a concept known as slippage, and it is very important to understand. Slippage inevitably happens to every trader, whether we are trading stocks, foreign exchange, spot foreign exchange, or futures. Slippage is what happens when you get a different price than expected on an entry or exit from a trade. Basically, price moves from our expected fill price between the time we place the market order and the order is executed by the broker. So back to our euro-dollar example, if a trader enters long at 1.40, though price rapidly shifts to 1.4002 in that time, we get a fill at this price, and this is a pip difference and equates to slippage. This can be said for a trader looking at the sell at 1.40. Should price slip to say 1.3998 in the time between placing the order and the broker filling the order, this is a 2 pip difference from the expected fill price, and it is again considered slippage. Guys, are there any questions on market orders before I slip over to pending orders? I hope what I've shown has given you enough to work on, and I'm sure most of us here are aware of market orders, so I don't anticipate much confusion with this. Okay, excellent. So moving over to pending orders, or sometimes called limit orders. Now, these are very, very important to understand and can be confused by some newer traders. So a limit order or pending order is different from a market order in that this type of order is only executed when price tests the limit price and is only executed at the limit price or better. It is also important to recognize that a limit order is placed above and below the current underlying price. So for a buy limit order, you place a buy limit order to buy at or below a specified price. So a limit order to buy at a price below the current market price will be executed at a price equal to or less than the specified price. So in this case, less than equals better than your limit price, so a lower level. On the other hand, you place a sell limit order to sell at a specified price or better, so above the limit price. A limit order to sell at a price above the current market price will be executed at a price equal to or more than the specific price. These orders therefore sit in the markets effectively pending until filled. So back to our euro-dollar example, or to look in more detail how a limit order works in terms of entry. Let's again assume current price for the currency pair trades at 1.4001 over 1.40. Again, the bid rests at 1.40 and the ask at 1.4001. Imagine the pair is trading lower. Imagine the pair, trending lower. Imagine the pair is trending lower, and as you can see from the slide, you feel a pullback is on the cards to form a sell on rally scenario. In order to ensure you have a good chance of catching the pullback, even if your computer is turned off and you're sleeping, you could set a limit order to sell at 1.4050. The same can be said if the pair is in an uptrend, of course, and we want to try and buy into weakness, a retracement. We could simply set a pending order to buy at a specified level below current price. Now, a question often asked is what happens if price opens beyond my entry limit order? Look, although gaps are not that common in FX, but they do sometimes occur over the weekends, a limit order is So look, a limit order is an order to buy or sell at a better price than the current market price. If the price opens or suddenly jumps to a level beyond a limit order, the limit order should be filled at the better price and not the price the order was originally set for. Here's where things get interesting. So what about a limit order in the form of a protective stop? First off, as I hope you can see from the slide, using our same euro-dollar example, a stop loss order is in place to protect your account from more than necessary losses, hence the term protective stop. So if you're long a currency pair at 1.4001, the protective stop would be below price, around 39.50 in this example, and if short, the protective stop would obviously be above your entry. Stop limit orders are another order to take into account. Although I do not know of many traders that using these to exit markets, they mainly use buy and sell stop orders, which we touch on next. But for a stop limit order, it is simply a way of exiting an unfavorable position by selecting a limit price. Exactly the same function as a limit order. Now, using limit orders to function as a stop, while it does effectively help specify a price level, the limit price could end up being triggered, but then not fill. Price could gap. It is possible price could gap, as we already explained a few minutes ago. It is possible price could gap through the limit price before filling the order, leaving the trader with a greater loss than anticipated. As remember, the limit order functions to execute at the limit price or better. In this case, the better would actually be worse for traders, as we would be looking to exit the market. Okay, any questions on limit orders? I'm throwing quite a lot at you guys here. No? Okay, brilliant. Okay, so buy and sell stop orders. This is another common order type we must acquaint ourselves with. Unlike the limit order we discussed a minute ago, buy and sell stop orders are effectively another pending order, but once filled, automatically transition into a market order. This is very important to understand. So a buy or sell stop order is effectively another pending order, but once filled, it becomes a market instruction. So as shown on the slide, again using our euro-dollar example, you place a buy stop order above the current market price, and it is triggered when price touches or goes through what's known as the buy stop price. Remember, a limit buy order is below price. A buy stop order is now above price. And you place a sell stop order where when a specified price, so below market price, a sell stop order is always set below market price. So these orders are used to function as both entry and protective stops. This is crucial to understand. Buy and sell stop orders are used to function as entry and stop orders, protective stop orders. Another crucial thing to be aware of at this point. Let me just explain this slide really quickly. I think just so I can drive home the idea. So current price is 39.50 on our euro-dollar example. If we believe price, so assume we're breakout traders and we're looking for price to break through the key 1.40 round number. We could set a buy stop order at this round number. So when price pushes through it, we get triggered for a market buy order at this price. We don't have to be at the screen. We can set all the orders as they're pending and then essentially shut down the system if needed. So another crucial thing to be aware of at this point, and this sort of extends on our brief explanation of liquidity earlier is that market orders consume liquidity and pending orders provide liquidity. Think of pending orders as the floor and the ceilings of the markets. It is also important to be aware that both limit orders and buy and sell stop orders are visible by the banks and the brokers on their servers. This is the liquidity or the depth of the market. Let me just say that again, guys, because I really want you to understand this. Yes, we have a question. Is this meeting recorded? Yes, it is, Marlon. It certainly is. So guys, look, market orders consume liquidity and pending orders provide liquidity. Both limit orders and buy and sell stop orders are visible by the banks and brokers on their server. This is the liquidity of the market. So now, for me, the interesting part, I'm going to go, what I'm about to go over, it may appear to be storytelling, but I can assure you it is necessary to understand. I assume the majority of us here, understand the dynamics of a trend. This is normally 101 learning for most newer traders. So when I say trend, I'm talking about consecutive higher highs and higher lows, which represents an uptrend, and consecutive lower lows and lower highs for a downtrend. This is simple stuff and should be learned, as I said, at the beginning of your journey. But do be aware, the market is a fractal beast, and we work with longer term, medium term, and short term trends. For anyone who has studied the Dow theory, this will be an easy concept to grasp, which are the primary trends for longer term, secondary trends for corrections to the primary trend, and minor trends, which are essentially price fluctuations on a daily basis. I will briefly go over the dynamics of an uptrend as how I see it. I will also try to keep this part relatively quick as time is really catching up on me. I would almost say it's common knowledge that no market moves in one direction for an extended period of time without pulling back or retracing. There are a truckload of methods that try to make sense of these moves within trends. You will often hear, this is very important, guys, and I really want you to take note of this. You will often hear people say price moves up when there are more buyers than sellers. You have to understand that this is impossible. The markets are a platform for matching buyers and sellers. If there is no seller, you will not be buying anything. Price will move. I'm trying to think of the easiest way I can explain this to you. Price will not move until a seller is found. It's as simple as that. So the markets move up because buy market orders consumed seller liquidity at a price level. The next buy market orders will consume the liquidity at a higher price. So remember that liquidity in this sense is sell limit orders above current price. As I explained, remember market orders consume liquidity and pending orders provide the market liquidity. So at times we're both we're consumers of liquidity, and we're also providers of liquidity. As retail traders, we also set pending orders and buy and sell stop orders. So let me try and explain what I mean with this trend. So imagine for a minute that the market is a ladder or a tall building with many floors or ceilings. So price can rise up when a ceiling is penetrated, and it can move down when the floor is broken. Some floors and ceilings are obviously thicker than others, and some are thinner than others. Something needs to consume these ceilings for price to move up. In the case of our uptrend here, the consumption of the consumption of liquidity is called, as I said, a market order. When someone submits a market order to the market, it consumes some liquidity and makes that floor or ceiling a bit thinner. And this is what causes price to move. So within a trend, markets on the rise. So a market that's on the rise here, as we can see, market orders are generally consuming sell liquidity. So breaking through pending sell orders in search of higher liquidity. You will see that breakout buyers coming in above previous highs. So breakout buyers will be positioned above previous higher highs at this point here. This is all really important to understand and will help position us in terms of the chart's psychology. So as I said, breakout buyers will be looking to take advantage as they know a trend is in process. There'll be breakout buyers with more than likely buy stop orders positioned above here for those that can't be at their systems at the time. There'll also be traders with waiting for more confirmation on the. Let me just get the to explain. So there'll also be breakout buyers looking for the break and retest scenario, and this is fine. This will also attract market orders to push the price higher. What we also have at higher highs is are sellers trying to fade these higher highs, these highs at this point here, because this actually forms resistance. Imagine this on the daily time frame. Imagine you know, this would appear strong resistance to a lower time frame trader on the H4 or H1, and there will be sellers attempting to come in here with protective stops above this area. So once price breaches this previous higher high, buy stop orders from breakout players are involved, and buy orders from the stops are also involved. This gathers fuel to push price higher and consumes sell liquidity at higher levels. Guys, are there any questions on what I've just explained here? Because this is really important to understand if you want to understand part 2 of the presentation and some of the bits I have to show in a few seconds. Okay, no questions. Excellent. Okay, let's erase the drawings. Excuse me, guys, just give me a second. Okay. So how can we take advantage of this knowledge? While I will be going over this in part 2, I thought it would be good to wrap this session with looking at supply and demand and round numbers. Also, to help clarify the basics, I will use drawn form, as you can see on the slide, to demonstrate. For anyone following my daily analysis will know when opportunities such as this arise, I will do my best to highlight them. So round numbers or big figures are important levels in the market. Most of us would agree on this, and most will know once a level of this nature is being tested, it usually garners attention, and with that attention it brings with it orders. This is not anything new, I know, but have you ever asked what really happens around these levels? So looking at the diagram of just say the pound dollar, this could be any currency pair, by the way. Price is now testing 131 from the underside at this point. As price rallied higher from this point here, this brought with it buyers especially down from this dip point here, and breakout buyers above here, who will be looking to take profit who may be looking to take profit at 131. This is common to see take profit orders pop up at this area. Usually these take profit orders will simply be sell stop orders, essentially telling the broker to remove them out of their position by selling at market around the round number. These orders to sell to close long positions are not really what we're interested in, albeit they help form resistance around the round numbers. We are, however, interested in fresh sell orders at 131. So fresh sell orders. So what I mean by this is sellers coming in off of this. So for instance, imagine the buyers covering their positions at this point, causing a retracement to form, which then, you know, it can form sometimes a bearish engulfing candle, a bearish outside reversal candle, a bearish a shooting star, anything that will draw in sellers at this point. So sellers will come in and start selling at this point. Where do you think their stops will be placed once they're selling at this area? If any of you guys have the answer, it would be great to hear. But sellers coming up from this point here will generally place their stop, as far as I'm aware, 10 to 20 pips above the round number. And these mostly, as I've already explained, consist of buy stop orders. Equally, we know above this round number, breakout buyers will be lurking, ready to pounce on any. So above this round number here, breakout buyers will be positioned, ready to take on, ready to pounce on any signs of a breakout higher. They can do this by either setting breakout buy orders above, so above this area. Let me just get the pen on there so it's easier. So they can do this by setting breakout buy orders at this point here. So when price breaks through the round number, they're automatically into a market order at this point. Or again, they can wait for a close higher to form and follow that with a retest. This is common, very common to see, but nevertheless, it has the same function in terms of order flow. So as you can imagine, a lot of buying at market occurs above this round number. And this is what we're really, really interested in. So knowing this and understanding larger players require orders to fill their orders, the limit sell orders, at a supply here would be perfect, of course. So let me just go over this. So this supply is positioned just perfectly to receive this buying pressure. So the buying pressure from the stops taken, or the buy stop orders from breakout buyers triggered at this point here, and also the protective stop loss orders from sellers that were just too greedy and couldn't hold on, and all at this point here that didn't move their stops to break even. But even so, even with moving your stop to break even at this point, this still becomes a buy order at this point. And also fresh sellers coming in here, trying to fade the 131 region, knowing that it's formed resistance already. So this would give other traders confidence to sell here. And this, in this case, would be a big mistake because price rushed through this area, taking out those stops from any sellers here and any breakout stops at this point, and also triggered the breakout buyers orders in the form of either buy stops or market orders if they're waiting for confirmation. So the limit orders set around these points here are what we're interested in. And this is where we should be positioned as traders. We should be positioned ready to take advantage of, it's going to sound rather horrible, but the pain in this market. So these buy orders will help fill these limit orders of larger players. Of course, at times there will be no larger players present at this point. It's not a guaranteed win, but this is trading. We work on probabilities. So look, guys, this is one scenario I look at on a daily basis, and it's something I would encourage you to pay attention to on charts. And what we're doing, as I said, we're looking to take advantage of the poor souls taken at this point here, the round numbers, because this is obvious to everyone in the market, and we know there's a lot of orders that accumulate around these areas. So we're looking to take advantage of breakout buyers. So guys, above here, breakout buyers are caught within what's known as a bull trap, and this, as its name implies, essentially traps breakout bulls. So I hope what I've demonstrated here is reasonably clear. Another point I will make is the supply. I would always look for a defined supply area above the level, and it would have to be fresh. If you're interested in supply and demand, I did a two-part series on supply and demand recently, where I went into detail how I locate supply and demand. But the nuts and bolts of it is I look for a consolidation. So I largely focus on drop-based drop formations and rally-based rally formations, which are, for me, considered continuation formations. I don't really focus on the drop-based rallies and rally-based drops, which are these. So we get a supply here. Sorry for my artwork. So the supply is here. So I focus on these kind of areas, the rally-based rally and drop-based drop. So drop-based drop, rally-based rally. And this is what we have here, a drop-based drop. So I look for a strong move out of the zone to form that's fresh. And ideally, what you're looking for is this area to be the decision point that eventually broke this round number. As I said in my previous webinars on supply and demand for me are decision points. They have to do some damage to the market. They have to break something of note. You can't just go picking any area that has this shape or pattern. It would, you know, for me, it's just not worked out that way. I've tried it when I first began supply and demand trading, and it just did not work well. It really did not. And another thing I would add here, for anyone that didn't see my supply and demand webinar, is I always look for supply and demand areas that price has not spent a long duration away from the area. So ideally, I would be looking for this to form and boom, break all these stops above here and then come down. Now, at times, guys, when this does happen, you will find price will come up to here and sometimes react off this area. Now, this is something you need to include in your trade management. So for instance, you enter here, stop above here. If it hits here and you see some signs of bullish intent, consider maybe moving your stop to break even, essentially reducing your risk. Now, guys, any questions on this setup? Do any of you guys use a setup similar to this? Okay, look, remember, limit orders. Oh, you do, Travis, excellent. Okay. Do you use it very similar to the way I'm demonstrating it here? You're looking to take advantage of the stops above well-known areas. Now, guys, this doesn't have to be just a round number. This is just easy. This is just an objective way of defining the support and resistance. Excellent, Travis, good. How do you find it, Travis? Are you finding profitable trades through this method of trading? As I was saying, guys, just really quickly while Travis replies, definitely. Excellent, Travis. Yeah, I mean, for newer traders, I believe Travis isn't a new trader if he's looking at concepts such as this, but for newer traders interested in trading, it's vital to learn the technical concepts. As I said at the beginning, it's vital to learn the technical concepts, but trading any pattern without understanding what's going on the chart in terms of buyer and seller psychology, it's very likely you're going to encounter more losing trades than necessary. This is just one of the setups you can look for. As I've said, this is a round number. This is obvious to everyone. This is very objective way of defining the support and resistance, and a very objective way of, a very clear way of knowing where orders are present on the market, in the market, sorry. But we can also use support and resistance. So another one, just to extend this slightly. So imagine we have the rally base, drop base drop here. We can also use, who's familiar with the double top formations? I'm very familiar with these. I traded these for a while, but I didn't do too well because I was positioned at the wrong locations all the time. So another formation. Sorry for my art, guys. This is so a double top formation. If you trade double top formations, always take into account where you are positioned on the bigger picture. So you're looking for the context on the chart. So if this is the case, the market knows where technicians usually place stops. So for a double top formation, the stop is usually placed above the highest peak within the pattern. This is typical. I'm not to say that every double top trader does this. Some will trade above the next structure, but generally I found that many traders will look above the highest peak within the formation. Now, knowing this, there are stops above here. And with that, we know we can take advantage of those through a clear-cut supply at this area. Now, again, guys, it might not be an amazing move. It might not be a move that gives you high risk reward, but they often react at these points and give you at least this area to the peak. So the area here is what you're looking at. So you would always try to reduce risk to break even around this point. So the highest peak within the double top formation. So that, because that would essentially be a support area at that point. So we have a comment from, I trade it when market is in a downtrend or at a peak in an uptrend. Yes, that's how I used to trade double top and double bottom formations. But always look at where you're positioned on the chart. Don't just take the double top formations because you're in a downtrend. Now this is something I will touch on in part 2. Within trends, markets are, dare I say, not manipulated, but larger players know where these stops are, know where the liquidity is. This is how they have to move. This is how they move markets. Let me just go over this a little bit. So look, limit orders as well as buy and stop orders, as I've said, are visible on servers. Now, if they're visible on servers, they're visible to the larger players. Now, many will refer to this practice, as we've just shown, as stop hunting, and will sometimes look to the broker as the cause. But this can also be due to larger market players upstream in the interbank market. Of course, some unscrupulous brokers do hunt stops, and that is how they conduct business. As far as I know, these are likely to be unregulated entities. Why would the broker do this? Well, although we mainly label brokers as brokers, I believe the correct term is dealer. Those who take the other side of your trade, your counterparty. So if the dealer is short to your long contract, and the dealer widens the spread enough to trip your stop, he has effectively pocketed your loss at his gain, right? I have never dealt with unregulated brokers or dealers, so I cannot really comment much more on this. But I will go into more detail regarding this in part 2. And as I said, if part 3 is required, I'm happy to go into that as well. I think I've covered most of what I wanted to get covered. I'm happy some of you are trading this way, so part 2 should be interesting. And if any of you do trade in this manner, where you look at market psychology and you look to take advantage of where stops are potentially placed, please do have some examples ready for part 2, which is on Thursday, and I'll happily go over them with you. That's fantastic. It's great to be learning. So any questions regarding what? Let me just delete this drawing. Okay. So I believe Q&A. Okay. Any questions? Yes, Travis. Yes. Trading psychology is a huge part to trading, but often overlooked, right? It's an often overlooked concept, and this is why I believe so many traders take trades at the incorrect time. So it's essential we learn the basics. It's essential we learn the patterns. It's essential we learn what support and resistance is. It's essential we learn how round numbers function. You know, you have to really study the patterns, that the textbook patterns that are being presented in the markets, to take advantage of those patterns. I know it sounds almost cruel, but this is what I've done, and I know a lot of consistently successful traders have done and are doing on a daily basis. They look for weakness, as many traders have called it in the past. They look for weakness on charts. Okay, so we have a comment. Can we also, Bitcoin, do you want to take a look at Bitcoin? No problem. I have Bitcoin on the chart right now. Yes, Bitcoin has, also we have another comment. I originally thought trading psychology was, so we have a comment from Travis. I originally thought trading psychology was personal. It is technical as well, but it's more than. I think I understand that, Travis. I'm not sure. If you could write that out again, and I might be able to. I originally thought trading psychology was personal. It is technical. Look, I think what you're trying to say. Oh, okay, Travis. While Travis is typing that again, no worries, Travis. Thank you. I'll go over Bitcoin. So we had someone asking about Bitcoin. Bitcoin's in a lot of trouble lately, guys, isn't it? I haven't looked at this. So here's another area of, this is very common to what I was saying. So we have a Quasimodo support at this point here, and this has reacted. Now, can you imagine how many buyers come in off this area? This is buyer central. Buyers are loving this area, but they struggle to get past the 36,000 area. And now what you're seeing is price is going to drop through this area, and now we're below 30K. We're below 30K. This is a major area for traders, and this is going to attract a truckload of breakout sellers. Now, I would be closely watching this demand here, although I don't like that price has touched this area already, but I believe that we are going to get some form of reaction. This will attract buyers, I believe, or larger market players, because of the amount of liquidity above the below these lows here. It's so obvious, I believe. Let me remove that, actually. That's not needed. But I hope you can understand what I mean by this. So buyers coming in here, buyers gaining confidence. So they're gaining confidence from this rally here. They're coming in again here, and now they're in trouble. The buyers are clearly in trouble, and they're being stopped out left, right, and centre. Below here, below here, below here, straight into pending buy orders. The best thing I can leave you with today is, look where you're placing your stops. This is what my mentor told me once. He said, look where you're placing your stops. This is where you should be buying or selling. And that really messed with my head, as you can imagine, because I was following many traders on forums and stuff, and watching them and understanding where their stops were placed. I was putting an incredible amount of effort to understand why they place their stops there and stuff like that. But then after my mentor told me that, place your buy order, or in this case, place your buy order where your stop would be. So your stop would be somewhere down here. If you're trading this Quasimodo support, so I would be looking to buy in this area in that case. So yeah, I think, yes, we have a comment here. Trading psychology is key to successful trading. Now, trading psychology is, it's twofold, isn't it, guys? So trading psychology is the mindset. It's being able to understand, accept that losses will occur. Trading is very difficult if you don't have a handle on your psychological space, if you will. But there's also psychology on the charts. We know buyers are going to be buyers are in trouble here. They're in trouble. Couple that with the 30K mark, which is touted all over the news at the moment. And there's going to be breakout sellers. I dread to think how many orders are placed here. I dread to think how many sell stop orders are here. It's got to be incredible. The pain going through this market right now is just, it's almost palpable. I can almost taste it from the chart. So anyway, so Travis says, I originally thought trading psychology was more of a personal thing, but now I know it is a lot more. The psychology works in the technical side of things as well as through pain. Thank you, Travis. Yeah, exactly what I just said there. There's two parts to it for sure, and a lot of people don't understand that. Hopefully, some of the newer traders do now. As I said, trading psychology, there are two parts. There's one with the mindset, which is incredibly important. If you're interested in learning that, I would thoroughly recommend the book by the late Mark Douglas, Trading in the Zone. It's a fantastic read. It's easy to read as well. And also for psychology on the charts, the one piece of advice I will leave you until Thursday is look at where you're placing your stops. Consider maybe entering there instead of entering where you initially were entering. If that makes sense, I hope it does. We have a question. What is the BTC recovery path to look at? I'm not sure what you mean. Do you mean where I believe it could reverse and trade higher? If that's the case, I believe there will be some buying action. Yes, reversal, yeah. So I'm not sure if it's going to be a reversal. That's pretty much impossible for anyone to predict. Look, as traders, we want to be reactionary, not trying to anticipate. So for instance, if we see buying pressure coming in here, we're reacting to the market, we're reacting to the moves coming out of this demand area at this point here. Oh, guys, have I shared my screen or not? My Bitcoin, I haven't, have I? I'm talking about a chart and you're not even seeing it. I'm so sorry. Oh, dear oh me. I'm talking about, right guys, I'll quickly go over this again. I assume you can see my Bitcoin chart now. I'm so sorry, guys, that I can go over it again, it's fine. Look, we had the Quasimodo, look, Bitcoin is in pain, all right? You can see it now, the Bitcoin slide. I'm so sorry about that, guys. I thought I switched over. So look, the Quasimodo support, as I said, we've got buyers coming in here, gaining confidence, buyers gaining confidence. Bitcoin's always going to go higher. You know, we've all read it before. Bitcoin, buy, hold, and you know, you've seen it all on Twitter. Hold Bitcoin. Now price is cracking through this Quasimodo support. Also cracking through the 30,000 mark, which is incredibly, you know, widely advertised through social media and news outlets. But the thing is, I'm looking at this demand here. Why am I looking at this demand? Yeah, it's because I know that there's going to be pain within this area, within this small area here. There will be pain. There will be sell stops coming in at this point here, sell stops from breakout sellers, and sell stops from those looking to that were long at this point and just did not want to get out of the market. That can be either in the form of breakout stops, or those that were just too greedy that didn't move their stop to break even are now in considerable pain. Okay, and we're going to be looking, and traders are likely going to be looking to take advantage of this pain around this area here. I hope that explains it. I did say that I'm not overly keen on this demand because we did stab into this area as we rallied higher. Nonetheless, I do believe there will be some bullish intent forming at this point here if we reach it. You can almost feel the pain on this chart, in my opinion, right now. Yes, apologies, guys. I really didn't. I thought I was talking to you guys through this chart. What values are the pain zone? Can't see. So we have a question. What values are the pain zone? So between 30,000, you're around 30,000 to the top edge of this. 28,400, so 28,400 to around 30,000, just this small area there. This is the area of pain, in my opinion. And I hope none of us are long at this point. So look, this is where I expect Bitcoin to show some support. Guys, any questions before I look to wrap things up? While you're doing that, I'll switch things back to the slides. Okay. Guys, if there are any suggestions, please do contact me at marketanalyst@fpmarkets.com. Also, guys, look, I'm active on the FP Markets Telegram channel, the Facebook and their Twitter. Please do consider following or subscribing for the Telegram channel. The sign up tab can be found at the lower left part of the website. As I've said, upcoming webinars to be on the lookout for our part 2 of this series, Trading Psychology. As I said, if you do trade in this fashion, using trading psychology from charts, do try and bring me some examples for Thursday. It would be great to look over how other people view this psychology on the charts. Petros, nice tip about the entry in the stop loss level. Yes, it really opened my eyes, and my mentor told me that about 8 years ago, and I've remembered it to this day. If you're struggling, look at where you're entering, look at your stop loss level, consider entering at your consider entering at your stop loss level and placing your stop loss level below that area. You're probably going to see a large difference, because I'm sure we've all been there. Price comes down, stabs straight into your stop loss level and reverses. There's a reason this happens, guys. There's a reason that happens. You really need to focus on this. This is a very, very important presentation, and hopefully I'll go into much more detail in part 2. But it will start with a recap, so don't worry if you've not understood it fully. So as I said, upcoming webinars to be on the lookout for. Part 2 of this series is on Thursday. Isaac is then back with you for a live trading session next Tuesday, and then I'm back again on that week on Thursday with a webinar on back testing, which I will touch on discretionary, partial discretionary, and non-discretionary automated trading systems. Guys, are there any questions before I sign off? Just check. Doesn't seem to be. Okay. Excellent. Brilliant. Thank you, guys. I really enjoyed this session. I hope you did. I hope you took something from it. And again, please do try and get some examples for me for Thursday, and we'll go over them together. Excellent. Thank you, guys. Have a great day, and I'll see you all again very, very soon.